What is going on, guys? Welcome to motherfucking day 12. All right. Hopefully, if you've been watching this, if you're barely getting into day trading this year, I salute you for watching this far. We're almost 2 weeks in. You notice how the views just kind of drop off, but only the serious people are really going to find value in this. But in today's video, we're going to be talking about premium and discount, basically going off the other video that I made the other day about what was it called? Internal and external ranges, right? So basically, premium and discount. All right, imagine you have an external range, right? Let's draw some price action here real quick. So you have your external range, right? You have a little bit of price action here. You have your external high, your external low. That's what makes a external range, right? You have your buy side and sell side liquidity, right? Liquidity on both sides. And you have a bunch of price action right in the middle, okay? You have a bunch of price action in the middle. Boom, 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 right? You have a nice solid range here. And it doesn't even have to be this like crazy, like this sideways. Sometimes you just have a range like this. But actually, you know what? Let's just keep it super simple. Okay. We'll just leave it like that for the sake of this video. Okay. So you have your external high, your external low. All right. So premium and discount basically is going to be the 50% level of this range. Anything above it is going to be premium. Anything below it is going to be discount. Okay. Meaning, if I take out this little handy dandy tool called the Gone box, you can also use the fib retracement tool here, which I mainly use, but we're going to be using the Gone box because it's easier on the eyes. You guys can see what I'm talking about way easier. The red box is going to be called premium of this external range, the premium market, right? It's going to be when market is in a premium. And then the bottom, right below the 0.5 or the 50% of this range is going to be discount. All right, what does this mean? Premium, you're going to look for potential sells into, the 50% level or the external low or any internal lows, right? Anything in this red box, anything above the 0.5 is premium. This is where you're going to look for shorts, sells, meaning when you make money when the market goes down. Discount, the gray box, is going to be discount. This is where you're going to look for buys up to the external high or any internal highs or into the 0.5, right? When market gets into a premium, you don't want to buy. Okay, you do not want to buy. Most of the time, you don't want to buy. Sometimes it is good to buy up there, but most of the time, you do not want to buy. You want to be patient, and you want to wait for market to come back into discount. It's kind of like buying your favorite food or shoes or whatever you're into, right? Favorite sex toys, whatever you guys are into. Oh my God, I hope that doesn't get clipped. But whatever you guys are into, right? You want to buy it when it goes on a discount. You don't want to buy it when they mark it up in a premium, right? It's the same thing with the markets, right? You have the premium market, you have the discounted market, and this works on external ranges. It works on internal ranges as well. You can go deeper with this stuff, like say like this price leg here, right? You could mark this up as well, right? So that you can do a premium. You could like mark this out in this internal leg within the external range, and you could find a premium market there, and you would want to sell it until it comes back into the discounted of the larger external range. But it's a little more advanced. We'll get into that a little bit later. I just want you guys to focus on the external ranges and then mark that out, and you guys will see that, okay, when it's in a premium, you'll see price react off of the premium market. You'll see what I mean here when I show you guys some examples. But when the market goes into a premium, you don't want to buy. When the market goes into a discount, you don't want to sell either. When the market's in a discount, you do not want to try and short. You want to short when it's in a premium, right? You want to sell when it's in a premium. It's like you want to buy low, sell high, right? You don't want to buy high and sell low. You're going to lose money, okay? That is pretty much what premium and discount is. You find your external ranges, you mark that out, you will see the premium side of the market of this external range, and you'll see the discount, okay? And you guys know what to do whenever market's in a premium. You look for shorts, or you look to offload longs or calls or whatever. If you bought it in discount, you want to look to offload them, vice versa for the short side. All right, so let's go into the market here. Jeez, had something in my eye, but let's get into the market here. So right off the bat here, I'm gonna go ahead and show you guys with the Gone box here. You guys can find the Gone box over here on the left side, right here, the Gone box there. I'm gonna take this swing low on the weekly. Actually, I gotta anchor it from the top so you guys can see this better. So swing high right here and swing low right here. Actually, this is when it happened right there. So imagine if this price here, imagine if this price leg was not there, right? So you have your current range, right? This is the external range. You have your swing low, you have your swing high on the weekly, right? This works on any time frame. Again, 1 minute, whatever. Everything's fractal. Okay. This works on any time frame chart. Okay. It doesn't matter what time frame chart. Just make sure you have a clear swing low and a clear swing high, and it's external. Okay. What do I mean by external? Right? External is any swing low or any swing high. Pretty much like this, right? Pretty much like this, pretty much like this. Once you see price start to pull back, you can consider it an external range, right? Because you have a clear swing low and a clear swing high, and then you want to watch the equilibrium of this external range, okay? And look at what happens. Price taps the equilibrium, dips barely into a discount, which is okay, right? And I'll explain later on in a different video. We'll come back to the same exact example to tell you guys why price reacted off here and why it made a higher high, right? We'll talk about why this reacted here specifically and it didn't go way into a discount. We'll talk about this same example a little bit later on in the academy. But as you guys can see, the nice reaction off of there, right? Price is making a high. We made a lower high. So, you know, this swing low here should send it to make a new high, right? Drawn liquidity is up here, made relative equal highs right there. Go to the daily real quick. Boom, right? Taps equilibrium. We have relative equal highs there. So we can assume that drawn liquidity is going to be up there just based off the speed and displacement that this is having. And obviously it gets hit. Okay. We're in a bullish trend right here on the daily. On the weekly, it looks a little bit different, right? Because we did make a lower low. And then if I just move my big fat head here and then I take this off, you guys will see what happens next, right? So if I mark out the range, the new range, right? From this new swing low to this new swing high, why am I marking this as my external range now? Right? I can keep it down here as well. But the reason why I'm marking this out is because if I'm expecting price to go higher, this should not come down to this low. This should be a protected low, a protected swing low. Why? Because it made a new high, right? It made a higher high. But then you look at the bigger picture, right? You have a high, lower, a higher low, higher high, higher low, higher high. Then you have a lower low, okay? So if we're looking at the bigger picture, this shouldn't get above this high. But if we're looking at like the smaller picture, this should continue, right? So if I'm marking this external range out, price should not even get below this low here. And obviously it does, right? At first, if you're looking at these candles here, if you mark out this swing high, right? Why is this a swing high? Because it's the highest point of these three candles. We start pulling back. All right, now we're in discount of this range right here, this external range right here, okay? Does this make sense? And then you get an obvious reaction, and we don't have any follow through to the upside anymore. We just slowly go down. And you can find trades within all of this. Again, remember, this is the weekly time frame, okay? If I start zooming in, you could dissect all these candles and find good trades within this discounted area. Okay, I'm just showing you guys examples right now. But we smash this low. We sweep liquidity on this low, right? So this range right here, I would delete it. I wouldn't even look at it no more. And now this is my new range right here. Right, hold on. Let me pull this out. Why is this my new range? Because it made a lower low. It breached the low that made the higher high right here in this little price action right here, right? We still have a bearish trend on the bigger picture. Okay, we made a lower low over here. So this should not make a higher high above this high. If it does, market is going to trend higher, most likely. All right, so now we have a new range because we made a lower low below this protected low that made a higher high. Okay, I hope this is making sense. So now we have this range right here. We have a new range, okay? So anytime the market is going up, now that we established our higher, like our bigger picture range, right? Our bigger picture trend, right? Even if we look on like the way bigger picture, right? But we're just focusing on this. I don't want you guys to go too to the left on the higher time frames because then you guys are going to get confused, right? We're just looking at this price action right here. This whole price action right here, okay? Now, we made a lower low, so this is our new swing high, this is our new swing low, right? So anything that goes above this in a premium market, we want to look to sell. We want to look to go lower and make a lower low. And obviously, we come into the premium market of this external range, right? And look at what we do, right? We close the body above it, which is okay, right, on the higher time frames. But eventually, we come back lower. We're closing bodies below the previous weekly lows, which is a bearish sign. We close another, boom. right? We don't close bodies above any highs, right? And we're in a discount. So this is a bad sign. And then boom, right? This was last week actually. We ended up making a lower low. Okay. So this range ended up working out, right? It came back into the premium market, and this is where you'd want to, if you were long somewhere in here, if you were buying, you want to start offloading in here. Okay. You want to start selling in here, right? If you're buying here, you want to start taking profits somewhere in here. Okay. It's the same thing on the lower time frames again. It's fractal. But if you were buying down here, you want to take profits in a premium market, and you want to consider maybe flipping short to go lower to make money when the market goes lower. Okay. This is how you use premium and discount. And now that it made a lower low, right, we want to look for, right, this is going to be, well, first, right, this is still too early to tell. We don't have a swing low yet because I haven't seen the market pull back, right? If the market starts retracing higher, this would be considered our swing low, and then we could use this new range right here, right? We can go here. Sorry, let me come from up here. Boom. So assuming that this is a new swing low and the next candle goes higher, this could be our confirmed swing low, and then we would look for price to reject around here in this premium range right here. The premium market of this range right here, right? This is premium, this is discount. Assuming that this is our new swing low, we have to wait till the next candle, but just assuming that this is a swing low, we'd want to see price action come up to here somewhere in the premium market, and this is where I would consider selling to go lower and take out this low and potentially this low. Okay, hope this is making sense so far. But yeah, it's very, very simple to understand here. And yeah, that's pretty much discount and premium, right? Again, look for a range, right? Look for a range, external high, external low, and then look for the market to draw up to premium, right? You want to start selling to maybe potentially go down to the external lows or whatever internal low you are targeting, and vice versa for the discount, right? You want to look for buys to go up to the external high. All right. It's as simple as that. It's not very hard. And again, the Gone box is a good tool to use to identify premium markets and discounted markets. You guys can copy my settings if I haven't showed it already right there. And then I pretty much use the fib tool nowadays. I don't really use a Gone box, but the Gone box is what I use when I barely started. But this is my Fibonacci settings if you guys want to copy. I would recommend just copying these three right here, the 0, 0.5, and 1 for now. We'll go over what these mean later on. But yeah, that is pretty much premium and discount and how you identify it. So hopefully you guys enjoyed the video. Catch you guys tomorrow in tomorrow's video, which we're going to be talking about patience. So if you guys have been enjoying the series so far, make sure you guys like, subscribe, comment, and let me know how you guys like the series so far. So appreciate everybody in here and everybody watching so far. Catch you guys later. Peace.